or I would say a couple of years, tax has clearly been dominating the headlines, and more of it on the international tax side. I don't need to take you through any of these things in detail as to what led to the BEPS project, how large multinationals were structuring their affairs between countries, moving profits, reducing taxes, what that has meant to, and the role that civil society has played, the role that governments have in terms of collecting revenues, how morality in taxes has sort of come up again. I personally think tax is too important a topic to be left for morals. To say whether you are obligated to pay tax, whether you have to pay tax or not, or is there a fair amount of tax. I am, my personal view is that tax has to be driven purely by law. There has to be a legal basis for collecting taxes. It can't be left to the taxpayers in terms of morality. This is not a donation. This is not a CSR activity. But our laws have to be strong enough to tax all transactions which the government believes, which the country, which is on the basis of the basic principle of taxation, providing natural resources, providing a market, etc., have to get their taxes, and that's a discussion for another day. But these are the kind of things that are sort of keeping the headlines. uh, the other very important thing that we have to remember when today we are talking of international taxes as compared to a few years back is really the global convergence. uh, you know it's no longer a case where countries do things on taxation and they stay like an island unimpacted by what somebody else does. For example, we've all seen what has happened on reduction of corporate tax rates. There are cuts in US, China cuts, then India has also cut taxes. Then, our countries doing some of these in a coordinated manner. Is there a convergence? There are things that we are seeing on trade wars, tax being the reason for that tension, whether it is equalization levy that we've introduced, other digital services taxation that France, Italy, UK, etc. are introducing. What US did as a retaliation to initiate what's called a Section 301 investigation to see whether these are unfair trade practices, and therefore should US be doing something. US is talking of retaliatory tariffs on French goods, whether it is on wine, whether it's on luxury goods. Both of them said they will ease off until December. France has again come back to say that they want to go ahead with digital service taxation. The larger point that I'm making here is today, whether it is a tax policy, the decisions that are being made do not actually just depend on one country. There is clearly a global convergence, and we need to be aware of this. uh, Look at what happened on the big Vodafone issue. Uh, India asserted the right to tax capital gains from an offshore deal, indirect transfer. Now, leaving aside the tax professional in me, should India have collected taxes when a global giant, a telecom company, exited what it often referred to as India telecom business by a offshore transfer and not pay any taxes in India? May not be the right thing, but unfortunately for us, at that point, Section 9 did not envisage a situation, or Section 9 was not such that such a transfer could be taxed. Now, we asserted our right despite that. Then we all know what happened on the amendment, and thereafter, now the arbitration. US has introduced beat and guilty regulations. Again, all of these lead to only one thing, that there is a connected world. Country specific changes will not be there any longer, whether we are looking at BEPS, MLI, which are the things that I will be covering going forward. But this, I thought, was a more important thing at a very high level that as practitioners, as tax professionals, we need to remember. What I will do over the next 1 hour, and I'll come to the topics. But before I get to that, why are we doing this now and why is this becoming so important? Currently, there is accepted inadequacy of the current laws, which effectively deal with all the new age business models. The laws that we have today, the international framework, and I'm talking of international framework and the treaty network and not necessarily the domestic law, are things which were put in place for brick and mortar, put in place when the digital economy was not there, or economy was not as digitized as it is today. Another important thing is the amount of aggressive tax planning that is happening today. There is definitely a pressure on governments to collect revenues. The governments are under a pressure for increased social security measures and spend. More importantly, what has happened, especially after the BEPS project, and I thought the BEPS project gave a direction for that, is there is a unanimity among countries on tackling these large scale tax avoidance. And countries have also started realizing that they can't tackle some of these things all by themselves, standing alone. It's better that they sort of do a approach which is sort of consensus and which all countries participate in. The other thing that you see on the right side, which is the civil society and morality on in taxes, which I just touched upon, is again a significant thing. I don't think any time in the past, if we were going back 20, 30 years back, there were as much awareness in civil societies as there is today. The classic case that I can think of here is, if you think what happened to Starbucks in the UK. Starbucks, UK HMRC announced that Starbucks has not paid any tax despite having operations and has losses in the UK, but has not contributed or paid any taxes to the HMRC. Whereas the Starbucks chairman, in letter to the shareholders, addressed to the shareholders in US, actually said that they're having a good business in UK and they're looking at expanding. What most people didn't realize at that point was that they were intercompany transactions, profits which were moved either because of interest, purchase of coffee beans, payment of royalty, etc. And therefore, as a group, they were making profits in the UK, but they were not really paying taxes in the UK because of their transfer price and their intercompany transactions. Now, what it led to was the civil society section where people boycotted, stopped going to Starbucks. There was a protest of sorts. And a lot of this, and it's a very fascinating story to read. A lot of this is available on the public domain, and you'll be able to read those. Starbucks actually ended up paying 10 million pounds in one of the years, and amounts to say that they're just paying it because they want to buy peace and they want to get contribute to the HMRC. Now, a lot of these are happening. There are civil societies, there are organizations, not for profit in US, which are looking at structures, which are publishing reports on that. Another very important thing that I've seen in this is, in the UK, there is a fair tax mark. There is an organization which grants a fair tax mark, and if you look up, you'll be amazed to see the number of businesses which have got the fair tax mark. The fair tax mark essentially is, as a group, you submit your structure to them, and that organization, which has a lot of people from ex HMRC officials, tax professionals who are doing it pro bono, look at the structure, validate that there is nothing from a spirit, substance over form perspective, no tax planning, no profit shifting that is happening. There are no aggressive structures, and they say that this company is paying, or this group is paying, a fair tax mark. What the organization wants to do is, like our ISI mark, etc., actually have a mark which consumers who have a responsibility to say that I will buy goods, I will procure services from a company which is paying its fair share of taxes. They will know that these are the companies, and then that mark is there, which is a very interesting thing. Again, you look at it, that's really a civil society thing in action, and it's not any of the tax authorities or countries who are administering taxes are doing that. Of course, there is a political backdrop. There is impatience with the traditional way of looking at arm's length price. Does arm's length price work, not work? Do you move to a formulary apportionment? Do you move to any other methodology? The pandemic and the growth in recent years has actually excavated all of these things, and now it's become even more important. A lot of the issues that I'm going to touch upon today, somewhere or the other, have a are having their genesis in some of these things that we are discussing, and that's the reason I thought giving this backdrop will be very important, so that we'll be able to appreciate why some of these issues are actually issues today, rather than any time in the past. The 10 topics that I have chosen to discuss. The first one is applicability of a multilateral instrument. How do you look at it? What does MLI do to us today? What is it that we have to be aware of at a high level? I'm not getting into each country, what India has done, because that is a topic by itself. uh, Denial of treaty benefits. what has happened recently, what is it that we should be doing as payers? Is there something that the payers need to be looking at? Or if we are part of a group where there are overseas entities which are entitled to treaty benefits in India, how do you sort of take care of that? The PPT, principal purpose test, and what it does, more so on withholding taxes. As a deductor, what is somebody expected to do on PPT? I'll cover a little on beneficial ownership. Again, this is something that the department has been quite active, and looking at beneficial ownership again has the genesis in all the things that I discussed in the last 10 minutes, whether there are companies interposed, jurisdictions chosen only because of treaty benefits and not really having a beneficial ownership, and we'll get to that. I'll discuss that. Importance of tax residency certificate and treaty entitlement. What happens if the TRC is not there? What do you do? What is your roles and responsibilities? What does the current law envisage there? Sixth one is the digital economy. Again, really an update here. I have no answers. This is not law, but this is something that we have to be aware of. What is OECD talking of? Where are we on the BEPS project? Characterization of software payments, whether it is royalty or not. Again, withholding, plethora of decisions there, for and against. I come from a state where the jurisdictional high court has held purchase of purchase of software to be royalty. What does that do? All of us would have discussed Pcom. Again, Supreme Court ruling in the case of Pcom. What does that do? Secondment, employee secondment issues, withholding tax, the Sentica issue, and thereafter what has been happening on that front. Lastly, the DDT case, whether the treaty rate applies for DDT, and would companies be eligible for a refund of dividend distribution tax paid in the earlier regime, not factoring in the treaty rate where the treaty rate is lower. These are sort of the 10 topics that I intend to cover over the next 1.5 hours or so. If there are any other things that any of you feel that you need to touch upon, please feel free to just step in and we could discuss those as well. So I'll just get to the first topic, which is applicability of MLI. Where did this start? The MLI, as we all know, came out of the BEPS package, was really a part of the BEPS initiative. In 2013 is when the first BEP action plans were submitted, and thereafter groups were formed for developing MLI. Final measures were released in October 15, and the text of the MLI was adopted in November 2016, and the first signing ceremony was in June 2017. What does the MLI do? The MLI is really an instrument which sits on top of the treaty. The reason and the primary reason for this to come in as a separate instrument and not really a treaty was the number of treaties that had to be amended if what the BEPS plan proposed was to be achieved, whether it is on hybrid mismatch instruments, preventing treaty abuse, or artificial avoidance of permanent establishment, or providing a dispute resolution. The treaties had to be amended, and at that point there were more than 3,000 treaties which had to bilateral treaties which had to be amended. Let us assume there was a reason, there was an action plan 7 which identified artificial avoidance of permanent establishment, which is by either fragmentation, splitting contracts, or because of the agency P, where the agent was actually not involved in conclusion of contracts but playing a principal role, and the BEPS action plan and the BEPS report concluded that these are two things which had to be addressed to avoid artificial shifting of profits, which means where there is actually a PE, you are avoiding it by either splitting the contract, or, and I'm just taking two examples, or by controlling the role that your agent plays. If these were to be implemented, for example, and all countries agreed that these are the changes to be done, if it was to be done by way of a treaty amendment, then there were more than 3,000 bilateral treaties which had to be amended. And all of us know what it takes for one amendment of a treaty, how much India has struggled even amending some of our bilateral treaties, and that itself is an exercise. So, at that point, the thought was that instead of amending so many bilateral treaties, can a separate instrument be put in place, which if two countries sign, then the treaty gets amended. And if one country signs and another country signs, you just need to see that if both are participants to that particular instrument, then can the treaty stand amended? And that's really the genesis, and that's really the basis of how a MLI came into existence and how it works. Uh, this deals with treaty related measures identified in the BEPS project. Like I said, artificial avoidance of permanent establishment is one, preventing treaty abuse by way of, having right clauses for limitation of benefits, any of those things, hybrid mismatch, or effective dispute resolution. Like I said, the rational one is speed, which we discussed, which is avoids the need to bilaterally renegotiate the 3,000 treaties that are there. There is consistency, ensures consistent application of the BEPS measure because it's the same instrument then everybody is relying on. Then centrally, BEPS, OECD can come up with even guidelines, commentary on how to interpret, etc. Today on treaties, we have multiple languages. There's OECD, UN model commentary, and there are things which outside of that, which countries can themselves adopt. There will also be flexibility in respect to coverage and application of non-mandatory provisions. The way the MLI reads is that the MLI has certain articles which go on to amend your treaty. You could choose options within that. Therefore, there's a lot of flexibility, even though there is consistency. Then there is clarity and transparency because of detailed explanatory statements and application toolkits that OECD can provide and has provided. How does this work when MLI applies or does not apply? Does the MLI apply in the first place? What you need to see is, have both countries signed the MLI? Have the MLI entered into force in both? And has the treaty been notified as a covered tax agreement by both countries? Now, if India has signed the MLI and Germany has signed the MLI, have both come into place? If they have both come into place as on today, come into force as on today, and then India has notified the India German treaty as a covered tax agreement, and Germany has notified India Germany treaty as a covered tax agreement, then the India German DTA stands amended to the extent of MLI, depending on which clauses and which articles India has opted for and Germany has opted for. Now, once the MLI applies and the treaty gets, so to say, amended, read together with the MLI, which provisions apply, you will have to see if either country has made a reservation on the application of the provision in the MLI. Have both countries chosen to apply optional provisions? Have both countries chosen to adopt the same options? If both the countries have chosen to adopt the same option, is when that particular article will get amended, will get read on top of the treaty. I can't repeat this enough. The MLI sits alongside or is to be read along with the treaty and modifies the treaty. It's not an instrument by itself. The treaty by itself cannot be read any longer. You need to see if the MLI applies. You need to see if that treaty, there are changes, there are things that countries have agreed to. So like I said, MLI sits alongside the treaty, modifying the operation of the treaty. It applies by virtue of the later in time rule. The MLI is not static. That is something that you need to remember. Countries can opt in to optional provisions, withdraw reservations, etc. The OECD website has a good toolkit where you can choose the two countries and see what is the current position on both those countries, which have they commonly opted, which they have not, which article actually applies, which does not. That's a good toolkit available. That's the last point on the slide here, which you know is available, is something that I think you should be seeing whenever you want to apply a treaty anymore. Of course, it does not preclude subsequent bilateral modifications of treaties. If countries still want to renegotiate, still want to go and change their bilateral treaties, that is also something that is definitely permitted. What do you do for application of the MLI today is firstly verify if the MLI has entered into force, verify if the tax agreement is a covered tax agreement, identify which provisions of the MLI apply and which existing provisions are modified, and if the MLI provisions have an effect to that. This is a step that you will have to see before you apply any of the provisions. What is important today from a practical perspective is really on withholding. Whether the impact of MLI provisions are to be considered at the time of withholding tax obligations. Now, you could say that MLI need not be considered because there is no specific onus on the taxpayers to apply the anti-abuse provisions at the time of discharging withholding tax obligations. The Act requires me to take the TRC Form 10F, and if I have that, can I go ahead with that? There will definitely be a practical challenge for the payer in terms of access to documents of the payee, extent of verification. There is an angle of impossibility of performance there. The non-resident payee is not really bound by what tax positions and view the payer can take at the time of withholding tax. So there will definitely be a pushback. These are points which make it difficult for us as payers or even as practicing chartered accountants issuing 195, 197, 195 certificates, 15 CSCBs, etc., to see if some of the MLI provisions have to be applied. What do you do in those cases? These are things which are pushbacks. But a withholding tax obligation under 195 is clearly and directly linked to taxability. And if it is taxable, if it is not taxable in light of Section 90, of course, because of which the treaty comes into play, and the treaty itself doesn't apply because of any of the provisions of MLI, or the provisions in MLI don't give me benefits of the treaty, then how will I link my withholding tax liability, which is completely based on taxability? Are there potential consequences of withholding tax default uh, because of MLI? All of these are things that we have to bear in mind. A classic example, and this is something that I was involved in a few months back, is to say that there are companies which are paying royalty, could be lease charges on aircrafts, etc., to an Irish company. Today, would you look at the MLI to see if there is a principal purpose test or any other provisions met? How would you as a payer validate some of those things? What is the safeguards that you will have to take as a payer on applying the MLI provisions? I'm not really on the MLI per se or getting into details on that, but more on practically implementing the MLI as a payer. There is some guidance on this in the SHOM committee recommendation, and I'll just read this. This is a important one. In view of the above, the company recommends that while processing an application under 195(2) or 197 of the Act pertaining to withholding taxes, the taxpayer should submit a satisfactory undertaking to pay tax along with interest in case it's found GAR provisions are applicable in relation to the remittance. We'll move to the next one. In case taxpayer is unwilling to submit a satisfactory undertaking as mentioned, the assessing officer should have the authority, with prior approval of the commissioner, to inform taxpayer of his likely liability in case GAR is invoked during the assessment procedure. There is a responsibility cast on the payer of any sum to non-resident under Indian tax law in form of withholding tax agent of the revenue, as well as representative assessee of the non-resident. The payer is required to undertake due diligence to ascertain the amount of tax payable in India, and in case of any default, it becomes the payer's liability to pay. Now, this was in the context of GAR. Now, if I am expected, I as a payer am expected to undertake due diligence to ascertain the current of amount of taxes under GAR, I would be expected to undertake a similar or at least equivalent due diligence on applicability of MLI and what is it that I need to see, because this becomes very critical, especially in case of provisions coming out of MLI. And I'll not get into PPT at this point because I'm covering that in detail subsequently. But any other provisions on fragmentation, for example, if there are clauses or on agency P, today one of the significant changes that has come about in MLI is the agency P, which earlier was if a agent had habitually exercised authority to conclude contracts on behalf of any enterprise, and that would constitute a permanent settlement. Today it is really playing a principal role in conclusion of contracts. If tomorrow you are making remittances to an agent overseas and the MLI comes into play, how would you look at it? Would you just look at it from a perspective of authority to conclude contracts, or would you apply the test of principally concluding contracts, and where will you draw a line and how will you examine this? In my view, the withholding tax provisions determination of income of the non-residents today cannot be seen dehorse the MLI. We will have to look at the MLI and look at what needs to be done. Unfortunately, today there is no guidance that department, CBDT, etc., has given to say that MLI has to be considered or not. Officers, I'm sure, while doing a proceeding under a 201 or any other things to examine these payments, will apply the MLI because legally that is applicable and they will not be able to ignore that. Then comes the risk of what happens in case some of these aspects have not been considered while making withholding taxes, and is there a liability? There are a few thoughts that I have, which I'll again discuss when I come to the PPT thing. Maybe it's time for us to relook at the declaration, the no PE declaration that we've been taking in case of non-resident payees, which does provide a protection for the payer for having done a due diligence, and protection from a penalty and other proceedings subsequently to say that I had exercised caution, I had done the due diligence and deducted tax based on these documents, and thereafter the department can always go after the foreign company in terms of the collection. Therefore, is there a need for us to obtain some of these declarations having covered some of the aspects of MLI? I would think the answer is yes. So whether it is an OPE declaration for agency payments and things like that, or royalty, etc., beneficial ownership, and maybe better to cover some of those things in the declaration that we'll obtain. So there are two aspects which overlap. One is beneficial ownership, the other is principal purpose test, and I'll cover those two separately.
Yeah, can I speak?
Yes, please.
See, my view is that withholding taxes requirement and this CA certificate, both are expected to be done according to the best judgment and in bona fide manner. So many of the treaty requirements, as you spoke about impossibility criteria, it's not possible for deductor to know the exact structure, and it is not possible also.
Right.
So he has to do due diligence in bona fide manner and honestly. Suppose if I come to a conclusion without doing due diligence and not deduct tax, that won't be accepted in a law. But
Right, sir.
after having done everything, then law does not expect any deductor to go beyond and collect his receiver's books of accounts and find out exactly whether there is a NT avoidance or not. So I believe that this should be the way we sign and verify our return, that it is to the best of his knowledge and belief. That's how this provision should be looked at. This is
Right, sir.
my
I
view.
absolutely agree, because a payer will not become an assessing officer. A payer will not step into the shoes of the assessing officer to examine and take a decision and do a quasi judicial role there. But I totally agree with the point you made that there has to be at least basic due diligence that will have to be applied. Some questions asked, some documents obtained. Otherwise, if we are just ignoring the existence of MLI, etc., then we are in my view asking for trouble in terms of any particular scrutiny examination that happens subsequently.
Yeah, it should be honest belief and not
Yes.
casually formed belief.
Correct.
Ajay, I have one question. I think on this MLI itself.
Yeah.
Uh, I think you did cover in your one of the slide that this 195, which is the responsibility of the deductor. Uh, you know, as far as the relevant dates are concerned for the instruments, which have been ratified by both the countries. Uh, let's take an example of the 23 countries where the relevant date is prior to October 19,
Right.
where both withholding taxes as well as other taxes gets triggered from April 20 onwards, and there is no confusion as far as whether
Correct.
the amended text would apply or not. But
Yes.
there is a confusion as to those treaties, especially which has been where the relevant date is after 1st of October, whether and how to interpret this relevant provisions relating to withholding tax and as well as other tax. So what's the logic, or what is your view? Take an example of Canada, which has been deposited in August 2019, and that is why its entry into effective December 2019. So
Correct.
from April 2020, whether the amended text of MLI would apply to India, Canada DTAA, or it doesn't apply, and how does this other taxes and withholding tax works from your perspective?
I think it will apply. I think there are few other things on mid-year as to which year do you take, but there it is clear that it will apply from the subsequent financial year. And I think in the example that you took, it would apply from the April 20 in that case.
Okay.
So the next topic, we'll just move on to the next one, is on denial of treaty benefits. Again, availability of treaty benefit has been a vexed issue. Today, there is information available about the structure, easily available to the income tax department, whether it is CBCR, master file, multiple other things. Again, Indian authorities are increasingly challenging the eligibility to claim treaty benefits versus even capital gains, etc. There was a recent advance ruling on denying treaty benefits to a Mauritius entity despite having a valid TRC. Now, what does that do in terms of the position on TRC being sufficient for beneficial ownership and for being eligible for treaty benefits? The adverse implications of treaty denial would be that capital gains would be taxable in India where there are treaties which provide protection for capital gains, or there would be a denial of the lower rate of taxation either for dividends, interest, royalty, any of the things which are there. Uh, all of the decisions that we have are in pre-MLI era. Tax authorities have a heavier burden of proof to establish that it was abusive in nature. Under PPT, we will discuss that in a few minutes. The burden shifts to the taxpayer to establish that certain arrangement is not abusive, because we will have to establish that the principal purpose or one of the principal purpose was not for obtaining treaty benefits. So this is one fundamental shift that we'll have to see from a treaty applicability perspective. Again, read together with MLI, PPT, etc. What is it that we need to be seeing from a treaty perspective? What are the factors that lead to the benefit, the lead to the denial of a treaty benefit? One is substance. How do we see substance? Is there any tangible assets, employees, office space, expert, financial advisors? Are there any of these things that are there? Are there meetings held for active discussions for critical needs of the project, whether it is capital gains? Then if it is capital gains, for disposal of share, acquisition of share, what we need to do on the money that is received? Does the company have an independent source of funds or income? These are things that we could look at. Choice of jurisdiction, again, Mauritius, for example, is not a financial center like London, New York, Hong Kong, etc. Does not boast of a seat, for example, civil aviation or whatever. If you're looking at Ireland, there are those things. Is that particular entity that you're looking at served only as a conduit for routing funds? Where are the decision making process? What happens to decision making process? Decisions are endorsed by the holding company, or is it being taken by that company? Who are the beneficial owner? These are the things that will have to be seen. Again, you'll also have to see substance or form. The economic rationale, substance in the subsidiary is required for claiming treaty benefits. Again, Vodafone, etc. is there. But the biggest thing is, what do you need to do to strengthen that relevant substance or the documentation if you have to mitigate any exposure against denial of the treaty benefits? What are the things that you'll have to keep in mind here where an arrangement or a transaction qualifies for treaty benefits, whether it is a reduced rate of withholding tax, royalty, interest, etc. You need to consider a lot of points before even assessing the principal purpose test. Are you looking at all of these things today? Does the relevant jurisdiction have domestic anti-abuse legislation which would preclude access to the treaty? I have a live situation where a large group actually has come back to say that we would not want to have the holding company in Mauritius move out because it is becoming increasingly difficult for us to justify our presence in Mauritius, the holding company in Netherlands, because we don't have any presence in Netherlands. We are being questioned in multiple jurisdictions where we are wanting to invest either by way of debt, equity, share transfer, etc., gains out of that, and very seriously considering shifting out of Mauritius for the simple reason that I will not be able to commercially justify being there in Netherlands. If I'm looking at Singapore, I have my regional headquarters in Singapore for Asia region. my regional tax head sits there, regional CFO sits there. So it is easy for me to say that Singapore is truly acting as a holding company for the jurisdiction, alongside working, having an operating company in Singapore. But me having a holding company in Mauritius or Netherlands is not actually making sense, because I'm finding it difficult to show what is the substance and what is being done in either Mauritius or Netherlands in my example. Again, the treaty between jurisdiction in which the parties to the transaction are resident, does it contain any anti-abuse provision? Look at MLI and see if those are covered tax agreements. Uh, have both the jurisdictions ratified the MLI, deposited the instrument of ratification to the OECD, and what happens on the entry into force? We just discussed that a while back. These are aspects that today you will have to look at before just applying a treaty, which we are used to in the past by just collecting a tax residency certificate. By just collecting a tax residency certificate, would we be able to apply the treaty with a 10F, etc., in a situation of MLI coming in, PPT coming in, and all of these aspects coming into play, which is on in substance, is there any activity happening there? Are we really eligible for the treaty benefits? I think we are clearly moving into a situation where the onus on all of these things will move to a certain extent to the tax payer to begin with. And of course, because of having a responsibility under the statute in terms of being a payer and deducting tax, some bit of it, not to the same extent like we just discussed a while back, will also move to the payer. And I like the word that sir used just now, we can't be casual about some of these things. What are the things that you need to keep in mind? What are the things that you need to apply from a treaty perspective? Korde sir, if I could just ask some comments from you on this aspect, especially your views on what happened at Tiger Global ruling, and how you believe that that is something that is not to be dismissed easily.
Yeah, I believe, see, the fundamental thing which you also spoke in the beginning of the session is the increasing tension between the governments and taxpayer all over the world about the sharing of revenue. Or rather, governments increasingly want, they feel that they need share of revenue which they are legitimately due. And that's why the everywhere the intolerance against anti avoidance is increasing. And that's why many of the moral arguments have a different side of litigation. Having said this, in this particular Tiger Global, the Vodafone 10 years ago viewed indirect transfer in a different manner, and probably they gave a benefit of doubt to the taxpayer that fine, this particular aspect was not known to them, and that's why Supreme Court allowed it. That's how I see it. But now judiciary may increasingly see indirect transfers in a different manner. And of course, there are many legal counter arguments against the criticism of AR ruling. So those we will have, court will apply, and at the end of the day, on a particular day, how particular judge or set of bench views indirect transfer is a different matter. So, but this is I feel is the underlying what you say uh, stream of thinking which is going on.
And sir, this is not sort of at this point, limited to any particular jurisdiction. And I was just reading things on China denying certain benefits to a Canadian company which had come in through a intermediary holding company, and claiming certain treaty benefits, and China denied the applicability of the treaty on basis that the number of people, the headcount, the capability of the people in the holding company that was shown was not sufficient for the amount of operations that that company was carrying on in China, etc. And every time something like this happened, and we had a recent case of Switzerland with similar facts, which I'll cover in a while. Every time some of these happen, because of interconnected thing, there is passing of information, people learn, and then those get implemented. And I think a lot of this is not limited to India anymore, and it sort of is across the globe.
Yeah, absolutely. That's why I say that. See, the other argument of moral or counter argument of this moral aspect of tax is that, as you would recollect, the principle of benefit principle, according to which the countries feel that, okay, you may not be legally liable, but you are earning using our infrastructure, using our environment in which you are growing, and using our legal ecosystem. So for whatever use you are making, you are expected to pay for that.
Right,
And
right,
and in my experience in Europe, this particular thinking is totally ingrained, that if you are using country's infrastructure, you have to pay. And this is economic principle. This is nothing to do with moral principle. So I believe that this particular line of thinking also will start taking its place in India as well.
right. We'll just move on to the next topic, and which is quite an important one in my view, is really the applicability of principal purpose test. And what I'm intending to cover here and what we will discuss, and again I would please request people to step in where they have experience here, is on applicability of PPT on the withholding taxes and what do we need to do. Not really what PPT is, what a limitation of benefit is, the simplified limitation of benefit, what those are, how does it apply, which India has opted for, which countries. That's not what I'm planning to cover here, because that's not that's a topic by itself for an hour or so. I'll just touch upon what PPT clause is and how it reads and what are the issues and what do we need to see there. The MLI mandates inclusion of a preamble as a minimum standard, and the preamble or a clear statement in treaties that countries intend to avoid creating opportunities for non-taxation, tax avoidance, or treaty shopping. Then the PPT rule is that if one of the principal purpose of the arrangement is to obtain the treaty benefits, then the benefits would be denied. In addition, the MLI allows you to opt for either only PPT or PPT plus the limitation of benefit rule, either detailed or simplified, or detailed LOB plus a mutually negotiated anti-conduit rule. So the PPT is something which we have to have. It is applied as a, what has India done on Article 7, which is on this, the PPT is being applied as an interim measure, and we intend to apply the LOB provision where applicable. And in addition to PPT, we will apply the LOB, or we will do a bilateral negotiation along with the simplified LOB. So the PPT being a minimum standard will be there as a part of all covered tax agreement going forward. What does the PPT, as we say, mean? This talks of, this is the clause, and I'll just read that. Notwithstanding any provisions of a covered tax agreement, a benefit under the CTA shall not be granted in respect of an item of income or capital if it is reasonable to conclude, having regard to all relevant facts and circumstances, that obtaining that benefit was one of the principal purpose of any arrangement or transaction that resulted directly or indirectly in that benefit. So what we need to see is, was obtaining the benefit one of the principal purpose? If obtaining the benefit was one of the principal purposes, then the benefits of the treaty will not apply, unless it is established that granting that benefit in these circumstances would be in accordance with the object and purpose of the relevant provisions of the CTA. So if the objects and purpose of the treaty is to grant that benefit, then you will get out. But this is more of a question of law and is an object and purpose test, whereas whether it is one of the principal purpose is a clear question of fact, and we need to see in that situation as to whether in that particular set of facts is claiming of treaty benefits one of the principal purposes or not. Take a situation that there is a Luxembourg company, which is a wholly owned subsidiary of a US company. The Luxembourg company has subscribed to CCDs of India, and then the Indian company has paid interest to Luxembourg company by withholding tax at 10%. It could be Cyprus, it could be any of these things where the interest withholding is 10%, and the Indian company gets a deduction for that interest at full rate. So therefore, there is effectively a tax saving. Then the interest received from that Luxembourg company is upstream to US by way of dividend. India and Luxembourg have MLI changes, therefore the PPT applies. And then the Luxembourg company holds a valid tax residency certificate. Now the question that comes up is really, can you say that the Luxembourg company was established for one of the principal purpose to obtain the benefit of lower withholding on interest income or not? This again, I just put that to just put a situation and not really more facts there, because what we have to do right now is really to look at what is it that we have to examine at the time of making the payment. Let us assume whether it is for group company or whether it is a structure with a third party where you are paying interest to Cyprus, Luxembourg, etc. What is it that you will have to see? Because you need to remember that PPT is treaty centric and does not permit any other approach, a look through approach or something. A PPT has an absolute effect of denial of the treaty benefit on those transactions at all. And the India Luxembourg DTA read with the PPT will not look beyond that. So therefore, what happens if there is a treaty benefit denied? One view is that if you deny the treaty benefits under the India Luxembourg Treaty, then the domestic law applies, because you are looking at the taxability of the Luxembourg company, and that Luxembourg company is not eligible for the treaty benefits. Then would the amount get taxed under the domestic law by not having a tax treaty rate at all? Or could you take a view that the PPT is restricted only to benefit quantified in comparison to the other alternative, which is the US company is actually getting a benefit by coming through Luxembourg in this situation? Had it not come through Luxembourg and had invested directly, then in any case, India USA treaty rates would definitely be applicable. The PPT requires denial of the benefit that you get from that conduit transaction, which is the US company has to be denied the benefit it got from coming through Luxembourg. The PPT does not envisage a harsher implication to say that the US company in this case will not even get that benefit that it was eligible for the India US treaty, but has to pay tax under the domestic law at 40% or whatever. Therefore, even when India Luxembourg treaty is denied due to PPT, can India US treaty still be applied? And if you apply India US treaty, what happens? Now, these are the two things. Now, how much of it would you see from a withholding perspective? These become extremely important in intercompany transactions, in group transactions, where even the argument to say that there is an impossibility of performance for me to obtain data, for me to obtain information, etc., may or may not be available depending on what the situation is and how the department will view this. All in all, I think even from a PPT perspective, what is important for us is to obtain robust documentation, appropriate declarations to be obtained from the payee before concluding the rates at which tax have to be withheld. Now, I had a live case, and this could be true for most companies. Aircraft leasing, one of the large aircraft operators, airline in India, making payment to an Irish company for leasing of aircraft, leasing of engine, etc. And they have no clue whether the Irish company is just a conduit, a shell company, has operations there. What are the things that they have to see from a principal purpose test? What is it that they as a third party, and it's an absolute third party situation, would they have to see while making the payment? Would declarations be sufficient? Now, some reading onto this, again, there is enough material. There are FAQs that are there as a part of the BEPS package on MLI in terms of PPT. There are things which there are a lot of examples there, and I would encourage people to read a lot of those things before you conclude on specific aspects relating to yours. I'm just looking at this leasing company example where there is some guidance on this in the BEPS packages to say that if there are other reasons, such as if you look at Ireland, are there availability of manpower, etc. And Irish is not the example that they have given there, but more of availability of experience, senior professionals, industry experts in that region, etc. And if you just dig a little deeper, and you can do it even in a situation like this, we came to a conclusion that Ireland today has more concentration of senior professionals in the leasing industry than any other country in the globe. And Ireland domestically has some of these people available, attracting talent who understand that business, who understand aircraft leasing, who understand engine leasing is significantly higher. Then can a declaration be taken? Can then a little bit of a due diligence be done, documents kept on files to say that this was sufficient for me to think and establish that maybe the principal purpose or one of the principal purpose of setting up a company in Ireland for this larger group was not tax treaty benefit, but was really availability of these trained resources, availability of senior manpower who understand the business, who understand the sector, and therefore that we may not be hit by PPT. And with this documentation that I have, with this declarations that I have obtained, I, as a payer, will continue to grant the benefits of the India-Irish Treaty to this particular recipient and accordingly deduct tax. Now, this is something that we will have to see from a case-to-case basis. Wherever we are looking at other situations, could be royalty, could be fees for technical services. Are there people who are there in that particular country? Is there some IP there? Is there people who are capable of doing, whether it is research, whether it is enhancement, any of the aspects of the DMP functions? Can we ask some of these questions, maintain documentation which support this? Otherwise, just taking nothing on record and not looking at the principal purpose at all is doesn't serve a purpose. Now, some of the things, another indicator for this, and those of you who hold shares in listed companies during the current year would have got a lot of these emails asking for declarations, asking for details of tax, residential status, etc., from a dividend perspective, because dividends have become taxable. And in some of these, for corporate tax holders, especially non-residents, the companies have sent declarations which actually have declarations to say the principal purpose declaration is there. And I've seen for a lot of the large listed companies have sent these declarations to all shareholders to say, please give us this declaration, includes MLI, includes PPT, to say that the principal purpose was not for taking tax benefit. Now, this may be a sufficient cover, may not be a sufficient cover. Time will tell. I think it would be, because we are being reasonable. There is some bit of due diligence applied, but definitely not worth going forward, making payments, taking positions on withholding without having covered the aspects relating to PPT.
Uh,
Yeah, sorry, somebody had a question.
I think Ajay, you have answered this question. I think the same question is being asked in the chat box, that does declaration from pay on PPT would be sufficient? I think
Yeah, I think at least, that in my view is a bare minimum, and we need to obtain those things because without that, then we'll not be even able to establish that there is some bit of judgment that we as a payer have exercised. I think at least obtaining a PPT declaration to say that it was not established for principal purpose, then as a, uh, SSE who's deducting tax, I think we should be sufficiently covered. The next aspect is beneficial ownership, and this is again sort of all of the first few topics that I've covered are in a sense linked, because all relate to the treaty rates and aspects of that, whether it is a PPT or a residency certificate, a TRC, or a beneficial ownership. Now, a beneficial ownership becomes extremely significant for recurring income streams such as interest, dividend, etc., where there are reduced withholding tax. It's even for royalty and FTS, but more so for dividend and interest, where the beneficial owner of the asset, beneficial owner is the one who gets the benefit under the treaty. The OECD commentary says that this measure is used to counter tax avoidance. It is not to be used to interpret it in a narrow sense to say that we will apply it very strictly to say deny everything if beneficial ownership is not proved, but it is only as a measure to counter tax avoidance. Should be understood in the context and in light of the object and purpose of the treaty, and the concept is based on the principle of substance over form. Conduit companies set up as intermediaries receiving income on behalf of other person also be denied tax benefits. So the recipient, very simply put and in short, is not the beneficial owner when recipient's right to use and enjoy the income is constrained by either a contractual or a legal obligation to pass on the entire thing to another person. A very simple test to say that would the beneficial owner be the person who is receiving the income if he is not having the right to use and enjoy the income and apply it the way he deems fit, but is constrained by a contractual or a legal obligation to pass on the entire amount to another person, he will not be the beneficial owner of such income. Now, what is it in the India context? In India context, there is of course the famous circular 789 India Mauritius Treaty, which categorically says that TRC is sufficient evidence for accepting the status of residence as well as beneficial ownership. Now, this validity has been confirmed subsequently by multiple decisions. I'm not getting into too much detail. We'll circulate this presentation. Those cases are referred, and I've even put the citation. But in short, whether it is for Mauritius Treaty, where there is a circular, and this has been extended even to Netherlands by some of the decisions, there is definitely a circular which says that a TRC is sufficient evidence for accepting both residence as well as beneficial ownership. Internationally, there are quite a few decisions which have actually gone into the application of substance or form, look at who is the controlling party. I was just talking a while back about China situation, and this was a case where dividend was distributed by a Chinese company to an intermediary holding company, which was an offshore holding company with the ultimate parent being in Canada. Although that holding company in this intermediary jurisdiction had 5 directors, 5 employees, etc., the Chinese authorities denied and said that the headcount and the operations of that holding company is insufficient relative to the Chinese operations. Therefore, they said that there is no beneficial ownership, and then we will not grant treaty benefits on this particular thing. They've also come out with a guidelines which talk of when do you look at a beneficial ownership or treaty benefit. They've said that the recipient is required to, if the recipient is required to pay or distribute all or a substantial portion, and they call out 60% of an income to a resident of a third jurisdiction within a set time limit, then that will result in refusal of treaty benefits. So the recipient is required to distribute substantial portion, and they call out 60% of the amount, then it would not be. The recipient has no or few business activities other than holding that asset from which income is generated. Again, assets and scale and number of employees are disproportionately small to the amount of income. Even then, you would say that the beneficial ownership is not with that entity. Uh, there are a few other things that China has put, even from a loan agreement perspective, a copyright or a patent. If there is another agreement on the basis of which for the same intellectual property, China denies treaty benefits. But without getting into the specific circular that China has issued, in terms of, just some principles that we have to apply looking at it, is that if you want to treat a person as a beneficial owner, based on all the legal precedents that is there, international commentary, etc., we've just listed down a few. One of the most important thing is the ownership has to be coupled with dominion and control over the property. That is, it should not be an agent or a nominee. He should be free and have the authority to utilize the income received, and that should be at the recipient's sole and absolute discretion. Should not have any constraints, either contractual or legal, with another third party. And interest in that economic attributes of the property, which is right to enjoy the fruits from property, right to decide upon usage, has to be there. There has to be some bearing of business risk, whether it is currency risk, investment risk, etc., commensurate with the activities and the income. When the interposed person in the contracting state is of economic substance, makes its own profit, it's okay. When you have to see whether that interposed person is a conduit company, you can see if it has very narrow powers, which is more like a fiduciary or an administrator, where you would appoint a third party administrator. Today, if you were to appoint third party administrator, escrow agents and things like that, there is very limited things that that company or that party would have. Are those things the situation, or is there a requirement, is there a absolute authority and right to use that income? These are the things that you will have to see. From a hygiene factor perspective, just please see whether the taxpayer is formed for business objective and not only for the tax benefit. Is there ability to make independent decisions on investment, expenditure, etc. at that intermediary holding company level, bearing of risks, and of course the last point, which is the most important, which is unrestricted right to earn income. Now the question that often comes up before us is it material to see how that income is applied? Let us assume there is a US company which invests through Mauritius, Singapore, one of the two countries, into India. The Indian company shares are sold or dividend is declared, and immediately thereafter the intermediary holding company declares dividend to US. Is that a relevant factor? Uh, in our view, that is not a material. How the income is applied, it is not necessary that that Mauritius or Singapore company in our example has to apply that income to make some assets for itself, etc. That is not material at all, as long as the decisions are made by the taxpayer independently and not influenced by anybody. If there is a functional board in Mauritius or Singapore which is capable of taking these decisions, which is authorized and has the ability, and they decide that there's no further things to be done, there's no investment that we can do, and in our view that this money can be distributed to the shareholders and it goes, and that decision is taken independently by the board there, then the fact that it has got distributed immediately to the ultimate company does not matter. However, if there are no hygiene factors, no decisions taken there, the money from India goes there in the morning and the very same day it gets distributed back, no board resolution, no decision taken, nobody in Mauritius has played any role, etc., then we are risking on the beneficial ownership bit. I think whether the beneficial ownership is at which level has to be checked after considering all of these factors. Again, like we discussed in PPT and other aspects, very important for us to have some of these documented. There are enough and more judicial precedents in India. I'm currently before a CIT appeals on a beneficial ownership issue, and the amount of details that the CIT appeals is getting into is in terms of board, in terms of the qualifications of the board member there, his past experience, what he or she is capable of doing, what he or she is uh, has a educational qualifications to make some of these decisions, not, etc. These are the details that they are getting into. Now, of course, at the time of withholding may not be required, but in terms of taking positions while we are advising the foreign company itself, or this is a group transaction, some of these things become extremely important from a beneficial ownership perspective. I have a question here which talks of outbound investment. FEMA allows one SPV, probably those might fail the beneficial owner test. Ultimate country may deny treaty benefits. I think, it is whether it is one layer, two layers. I think the most important thing is the capability and the role and what the intermediary holding company is capable of doing. And if there is nothing on substance on the ground in terms of people, employees, decision makers there, I think that will lead to the risk of the treaty being denied, and that's something that we will have to be aware of.
Ajay, should we take a 2 minutes break? You have been speaking for
Sajjan,
more than an hour.
I will finish this, because then if we finish this one, then all subsequent ones are not linked. These are sort of together, and there is an underlying thread, and I can finish this one topic and then we could take a 2-3 minute break.
Sure.
Thank you. So then next topic is on tax residency certificate and the relevance of that. I will sort of jump through this slide, and then the only important point here is from an India tax perspective. Our provisions, our law mandates obtaining a TRC from a resident country to avail TT benefit. There are divergent views on whether merely obtaining a TRC is conclusive evidence to demonstrate everything, or all that we discussed in the past is relevant. Because if we conclude that TRC is a conclusive evidence, then beneficial ownership, none of these things matter. But it's not that simple. We are talking of a situation where there is an Indian company which is of course, resident of India availing services of installation and commissioning. And at the time of making the payment, the US company could not furnish a TRC. And India company remitted the payment for services away from the US company without deducting tax, taking recourse to the India US TTA, probably because of make available and multiple other reasons. In absence of TRC, whether the India company can grant treaty benefits to the US company. Now, this is really the issue because, especially in third party cases, sometimes you don't get a TRC. Sometimes the application itself, the TRC itself is not valid, or they would have applied and it doesn't come, and your payment becomes very critical and you would have to remit the money. There are a couple of decisions. The most important one on this being the Ahmedabad Tribunal decision, where what was held was that Section 94 requiring the furnishing of TRC does not start with a non-obstante clause, and reference to Section 92A, which provide that GAR provision shall override is there. And therefore, they concluded that mere non-furnishing of a taxation certificate cannot be construed as a limitation to the treaty benefit. Therefore, even if TRC is not there, just because that is not furnished cannot be taken as a limitation to treaty benefits. Again, similarly, Hyderabad Tribunal held that despite best efforts, if the SSC was not able to procure the TRC from a country of residence, then the situation may be treated as impossibility of performance. These are two tribunal decisions which have held that even if a TRC is not there, you would apply. I think in my view, the key takeaways here is that there is, of course, the CBDT circular, which we talked of, which says that a TRC is sufficient for beneficial ownership and everything else. The Parliament was aware of the above circular and dropped the enactment of this along with 4, which states that the TRC shall be necessary but not sufficient condition. In absence of TRC, I think the SSC will have to substantiate the residential status by way of documentary evidence. If TRC is there, that will be a conclusive proof of tax residence, and tax authorities may not go beyond the TRC. Then you are not really fighting on anything other things on just the tax residence. In case TRC is not provided by the payer, by the payee, then the burden of proof will be on the SSC to substantiate that residency with supportive documents. Therefore, we've discussed this, and I thought I'll cover some of this a little comprehensively. What is the relevance of an undertaking or an indemnity? There will be a practical challenge to obtain appropriate documentation from especially third-party vendors. There will be complexities involved when there are MNCs involved, where there are structures which are there, which leaves room for certain uncertainty, even after you've finished your due diligence. There are certain things which become difficult to conclude because of MLI, etc., which is subjective. How do you read this? These are things which are practical difficulties. So can we look at a declaration which will say that we are a qualifying person under Article 3, I'm a resident of such and such a contracting state, and I have obtained a TRC. I do not have a place of effective management in India. This is another important aspect. Do not have a permanent establishment in India. I am eligible to treaty benefit and I satisfy the principal purpose test, and I am the beneficial owner of the income. If we have this, after we have undertaken a detailed exercise and we maintain some of these documentation in place, and we have this declaration, I believe from a withholding tax perspective, at least we would be safe. Again, very important, the last point that I've put there is some of the declarations, if we can relook at it. We've sort of put in place a very comprehensive declaration, some of which may apply, some of which may not apply, but good to undertake that exercise, put an absolute comprehensive declaration in place, at least on third party transactions where we are protected from a penalty and an interest perspective for withholding. Sachin, I'm just seeing there's a question, and I'll just take this and we could take a break. Yes, I have a related question on withholding and treaty interplay. Most of the agreements of entities with MasterCard are net of tax arrangement. Historically, payer takes a conservative position on FTS. Post MasterCard ruling on PE in India, what will be the impact on payers on tax costs considering the arrangement is net of tax one? I think, it's not just MasterCard. I think on permanent establishment, including Formula One, etc., we've had some rulings which have sort of lowered the threshold, so to say, for PE, whether it's on fixed place PE, having access to the track and etc. for a few days, whether it is service PE, agency PE, etc. and MasterCard. with deputation of people. Clearly, the at least the judicial threshold for permanent establishment has been reduced quite a bit in the recent past with some of these rulings. I think that does pose a challenge, because if the department is to rely on some of these things, we would get into a issue on what would be the position that as a payer you would take on net of tax contracts. The issue would be that you would be bearing the taxes, and therefore you will not have any particular support in terms of getting documentation structures etc from the recipient, because he has nothing to lose. The taxes is on account of the payer. That does pose a significant challenge. We've generally been taking a thing to say, can we, instead of paying net of tax, do it with an indemnity etc, where we actually indemnify the loss, so that it happens only when the situation goes bad and there is a actual demand etc, rather than bearing the tax upfront. uh, I think the declarations, etc., is what would help even in a net of tax situation, to take a position that there is no requirement to withhold tax, and take declarations on presence, on secondment, on right of disposal, etc., including MLI and PPT, to say that there is no permanent establishment. That would be the only thing. But otherwise, I don't think there is any significant thing that you can do to completely rule out the risk on that permanent establishment issue. Sachin, I think we can take a 2-3 minute break and then come back and cover the other things. Though the other points that I have are not sort of interlinked and related to what we have just discussed.
Sure, Ajay. Sure. We'll take 2 minutes break. Sure.
Sachin, we can start whenever you think we're good to start.
No, Ajay, you can start whenever you are comfortable. No problem. Please go ahead.
Thank you.
Yeah.
So, the next topic I wanted to cover is on digital economy and where we are today. And this is one topic which, unlike what we have discussed until now, is not something which is codified, is not something which is in large parts not forming a part of our statute. But I thought as professionals, it's very important for us to at least know the overall direction, so that when we are today looking at newer transaction advising clients, it's important for us to know what aspects are being talked of currently. I think this is something all of us will have gone through, discussed, aware of multiple times. But just for the for the sake of setting the context, I think really the differences between the two business models, where there are digital businesses and non-digital services, where the fundamental difference being how value is created, which is in the first case is trading of physical goods and services, second is online services. Now, it's not about digital economy, but it's about the digitized economy, which means today a lot of the brick and mortar, a lot of the physical goods and services are also getting digitized, which makes it even more difficult. And real issue in all of this is who gets the right to tax and where is the value created, and how do you tax it? Because in a digital situation, value is created in multiple countries, created without actually having a physical presence. Then how do you tax it? It's very unclear where the revenue generating activity takes place. Is our current set of laws sufficient for that? There's enough and more work that has happened on this over the last 5 6 years. I will not really spend too much time on this. I think where we are today is the OECD is trying its best to get to a consensus solution. They don't want any more of unilateral measures, countries dealing with their own tax laws to bringing to tax a lot of these digital companies, because the fear is that you will move from a non-taxation or double non-taxation to the same profits being taxed multiple times, because each country does its own basis of taxing this digital economy and digital businesses. So the OECD did come out with quite a few options to begin with. Then some were discarded, and then they said we could sort of address it in two pillars: pillar one, pillar two. Public consultation has been going on for that. There's not much consensus that they've been able to get until now. US walked away from the discussion, so that was another setback. Hopefully, that may, or rather, I don't know. It's my guess is as good as anybody's. Whether the change in administration that is likely, will there be a rethink in the US on that? My personal view is it may not result in a rethink, because uh, end of the day, there could be criticisms about the past administration or the last administration, multiple counts. But if you really see the decision to walk away and not be a part of consensus, not be a part of this, was really national interest at the heart, because it is about US giving up the right to tax some of the large US digital corporations being taxed in different places. US either having to give credit for that or give up the right to tax is what led to that. And I don't think any government in US will willingly be ready to do that. So I don't know how much of it will change, but we'll have to wait and watch. But that's where we are. The the proposed long-term solution is a consensus approach that all countries agree together, something like what MLI has happened. Look at implementing these changes together, so that there are no laws and arbitrage opportunities possible for MNCs. Pillar one is a unified approach, which talks of new nexus rules, which is unconstrained by physical presence. So the earlier international tax rules always linked a taxing right to a physical presence in form of a permanent establishment, whether a fixed place PE later on being extended to a service PE, agency PE, etc., where no physical presence, but still a physical presence of an employee or an agent in that other country. Today, the nexus rules are the new nexus rules would be based on markets being users being present, there being revenue in a particular country, and can that be a basis for a presence and a taxing right is all what the unified approach in pillar 1 is about. Thereafter, getting into a profit allocation rules, once you have established that a physical presence is not required for a taxing nexus and a nexus is created without a physical presence, thereafter you allocate profits, and they have looked at a profit of deemed residual profits a fixed percent, and then for distribution function. This is additional return based on transfer pricing analysis. I'm not getting into too much detail here. End of the day, what they are looking at is companies having a taxable presence in another country, not just because of a physical presence, but because of user revenue, multiple factors. And thereafter, the profit attribution also being based and factoring in into some of those things rather than just a pure simple arm's length concept. The second pillar talks of a global anti-base erosion proposal, which is to have a minimum tax concept, which means a company pays a minimum tax at a particular level across jurisdictions and no less than that. Now, the difficulty will be to arrive at that. Again, the let us assume for a minute that we are where we are on the proposals and no consensus is happening. The real problem is the countries increasingly implementing unilateral measures. There is India that has started, Australia, Italy, France, UK, all started with digital services tax. Spain has introduced recently. Now, some of these have led to US investigating digital services tax. What will US do in terms of those measures, any retaliatory measures that will be there? That is something that we have to keep an eye out for and what it means. I will get to what India is doing on this in a minute, but otherwise, the US groups have urged India to delay the recently introduced equalization levy. We'll get to what the equalization levy and those things. There is also a recent development on UN Tax Committee considering adding a new automated digital services Article 2 model convention in Article 12B, which is now often famously called as the Bansal proposal because Rajat Bansal, who's the IRS officer as the representative of India and member of that committee, was one of the key brains behind that particular article. It's basically adding a new article which will tax automated digital services like royalty and FTS at a particular rate on, by giving the country to collect taxes in the UN model. There was also a recent discussion at the OECD where the OECD actually said that it's finding hard to reach an agreement on global rules for reallocating profits. Of course, US will take some responsibility, like I said, and China has some concerns on other aspects of Pillar 2. And the pandemic has also created the risk that OECD is not able to meet as often. Don't know if that is also delaying. They ought to have come out with the consensus by this year end, and that has not happened. That's now got pushed to mid 2021. And my view is that unilateral measures will continue till then. I don't think countries are ready to wait. India introduced significant economic presence in our domestic law. Of course, impacts only non-treaty countries. Uh, our SCP rules say that there will be a business connection and a presence in India if there are more number of users and revenue, and which has to be prescribed. India deferred applicability or getting that into force to April 2021. And in the budget memorandum, the finance minister had indicated that this is because the OECD is doing its work and we'll wait to see. And I don't think India will be ready to wait beyond April 21. That's my personal view. I think that would be the similar thing across the globe, and there will be more and more of these unilateral measures that will be coming in, which makes it quite challenging for us as professionals in terms of what happens on credits, etc. Now, if you see, equalization levy has been brought in under, it's not a part of the income tax. It is outside the Income Tax Act. What happens in terms of the levy? Is it unconstitutional, extraterritorial? Those are some aspects. There are interesting and very interesting arguments on if this is viewed as an indirect tax, then it ought to have come in only as a GST and anything that comes in. And if it is actually a GST article in the constitution and not the income tax article that the government has invoked powers to introduce, then it should have got routed to the GST council, and it could not have come without the GST council. Does it make it unconstitutional? These are things which are there. Mastercard, of course, has filed an appeal on equalization levy. I'll come to that in a minute. So this will get challenged in my view. There are things that will happen on the equalization levy. We've had some very interesting conversations with US companies on credit for equalization levy. Even though equalization levy is not a part of Income Tax Act, there is one school of thought in the US to say that this ought to be eligible for a credit in the US, because US grants credit for income tax or taxes in lieu of income tax. Now, would this be an amount which is income tax in lieu of, a tax in lieu of income tax? Because it's important to remember that equalization levy does not apply where a permanent establishment is there, and therefore does not apply where income tax is paid by the taxpayer. And once equalization levy is paid, there's no income tax liability, at least from the next year, not the current year, but from April 2021. So to that extent, equalization levy and income tax are mutually exclusive. Therefore, is this a tax in lieu of income tax? Of course, it borrows all administrative machinery, collection machinery, appeal mechanism, everything from the Income Tax Act. Therefore, can it be said to be a tax in lieu of income tax, therefore eligible for a credit in the US? These are things that are interesting, will be good, will only be increase, they will only increase further with more and more such levies. But this is most important aspect on this. I think we as professionals will have to remember. Again, India is actively involved, like I said, in adopting unilateral measures. One is equalization levy, which I spoke of, significant economic presence. Then we also had the draft rules for profit attribution, which CBDT had released, which proposed a formulary apportionment, of course, a formula which gave effect to users, revenue, etc. So we'll have to see where that will come in. That together with significant economic presence will make a huge difference if the CBDT does go ahead with the profit attribution rules. On significant economic presence, they had invited public comments on the amount or the threshold of users and revenue that has to be given for prescribing for ACP to come into play. That has not been taken forward, may get revived in my view, given what is happening. Another update on this, which all of us have to be aware, was MasterCard filing an appeal before the Delhi High Court. Here was an interesting case, and somebody just asked a question a while back on MasterCard. MasterCard was held to have a permanent establishment for its activities. And it was held to have a fixed place PA, agency PA, and a service PA, everything. So let's say that they had a permanent establishment, and that dispute is on, that order is under a challenge. So the question was, would they be liable to pay equalization levy? And MasterCard filed a writ before the Delhi High Court to say that since the case that the petition that it did not have a permanent establishment in India, and if the department is alleging that they have a permanent establishment in India, they cannot be asked to pay both equalization levy and fight a permanent establishment battle. Therefore, they actually sought direction that they will not be liable for equalization levy. The Delhi High Court actually held that it will become liable to pay equalization levy if it succeeds on this permanent establishment, and if eventually MasterCard is held to not have a P in India, then they would be liable to equalization levy. And therefore, right now, a stay be granted on application of equalization levy in the case. So that's where we stand on equalization levy vis-a-vis permanent establishment. We are also having a couple of large cases where there's a PE dispute and could potentially get covered under equalization levy. I think the bigger issue on equalization levy at this point is it is very wide in its coverage and has a definition which can sweep everything under its ambit. Anything that is electronic, technically even orders placed on email, etc., could get covered. So the applicability of equalization levy is something that is another very important aspect on digital economy and those things. Directionally, the OECD proposals, in my view, are in India's interest. However, what we are doing looks at approaches two different ways. One is the CBDT rules on profit attribution gives appropriate weightage to the entire profit derived from the market jurisdiction, whereas OECD looks at only residual profit. That's one significant thing. And CBDT recommends a profit allocation even in situation where there are losses globally. These are two aspects you have to remember, where CBDT's approach is in that sense slightly different from what OECD is proposing, even on profit attribution and on what is the base for profit that is to be allocated. I'll move to our next topic, which is again very important, being a subject matter of dispute. And here we could cover not just payment of software, but other things which are there on FTS, royalty, etc. Overall, the issue is really whether payment for use of software constitutes royalty under the act or the treaty. Now, the revenue authorities have always been alleging that any payment for purchase of software from a company outside India, which is for supply of software, will actually be for user right to use a copyright patent invention process. They say it's all of these things, not just one of the thing, and therefore it is taxable in India on a gross basis. This is a dispute which has been on for a long time. Taxpayers say that software does not involve any right to use a copyright, patent, etc., and it is business income and therefore not taxable in India in absence of a permanent establishment. Of course, this is a international, internationally litigated. There are issues that ATO is dealing with. There are some rulings in the Australian tax office, including in the case of Tech Mahindra, etc., where even Australia in some cases has held that it will be royalty. Now, the taxpayer's contention has always been that granting of a license cannot be given a wide context and be read along with all the transfer of all or any rights. Definition cannot be imported from the Copyright Act. And of course, what the taxpayers are telling is today, if I were, so what's the real issue? If I today buy a shrink wrap software, and I'll oversimplify it and take a very simple example. If I were to buy a license of Microsoft PowerPoint paying X dollars, am I getting a right to use a copyright and therefore will it be a royalty, or am I getting a right to use a copyrighted article without actually getting any rights in the source code or anything? The fact that I can copy it onto my computer is given. The fact that I can use it is also given, but I can't distribute that. And does that make a difference? The revenues contention has always been that it is a plain reading, granting of a license, and the phrase is in respect of. So therefore, a right to use or anything granted in respect of a copyright gets covered. They draw reference to the definition of copyright in Indian Copyright Act, and copyright being a negative right, even the slightest right would constitute right. Therefore, if I'm getting a right to use, it will get covered, and therefore will it be royalty. Of course, there are rulings in favor of the SSE against. There is Delhi High Court in favor consistently. Karnataka High Court has been against. Samsung and a lot of others, Samsung being the lead case, has had its own journey. In 2009, the Karnataka High Court actually ruled that this would be royalty. Went all the way to Supreme Court. Supreme Court sent it back to Karnataka High Court. In the second round, Karnataka High Court again held that it would be royalty. And now we are before the Supreme Court. The Supreme Court really, hearing has been getting adjourned, not being heard for a while now. It's still pending before the Supreme Court, so we'll have to wait and see. From a Karnataka perspective, we are having a difficulty by having a jurisdictional High Court ruling which says that this would be taxable. There are two parts to it. One is the end user, which is the example that I took, which is if I were to buy a Microsoft PowerPoint or a Word license, would I be liable to pay tax on it, deduct tax on it? Would Microsoft be liable to tax in India because of having granted a right in a copyright to me or anybody else? The second is the distributors of software, and some of this is in public domain. So Sonata is one of the largest litigators on this. They are the distributors of software. So if they were to buy 1 lakh copies of Microsoft Word, Windows, whatever, and to distribute, would they also be on the same footing? Because in a physical copy, if it was a shrink wrap box, the boxes that used to come, they would not even open the box and they would just buy it and sell it. Would they be on different footing because they get no right? But today, none of these get transacted or sold on a CD like the past. You could download it on a cloud. You could get a access code which you will just enter on a website and download it. Therefore, would a distributor be getting any rights? In my view, distributors stand on a slightly different footing because they don't even get a right to use the software. And in a case of a software distributor, maybe easier to take a position that it would not be royalty and not be liable to tax in India. Whereas in a case of an end user, it is still open, and the Karnataka High Court ruling is there. That is something that we can't wish away. And there is a amendment to the domestic law. Therefore, in non-treaty countries, we have very little uh, flexibility in a treaty country. At least you could take the definition of the treaty to say these would not apply, at least outside of Karnataka, where the Karnataka High Court ruling would not be applicable. Then there is also the recent equalization levy for supply and service of facilitation of service, whether such levy applies on software payments also need to be analyzed, because if it is sold online, if it is supply of goods online, would it get covered under equalization levy? This is a very interesting interplay again, because would you pay 2% and get out of a 10% royalty, and would this year both are applicable, and we are looking at from April 1 to say that if a equalization levy is discharged, would that absolve somebody from an income tax levy? Because the exemption, the way it works from next year is that once you paid a equalization levy, you get a section 10 exemption in the Income Tax Act. Therefore, in my view, firstly the equalization levy has to be examined, and if equalization levy applies and you have discharged equalization levy, that amount would not be taxable in the hands of the non-resident because of a section 10 exemption. So would discharge of equalization levies be sufficient going forward, is something again we'll have to look at from a 1st April perspective. Otherwise, until the Supreme Court ruling comes out on this, this could continue to be a issue which will be sort of vexed, especially in those cases where there are jurisdictional high court or tribunal rulings which are against.
Ajay, Amey here.
Yes, am I?
A quick question around software payments, online software payments, and interplay with the equalization levy.
Right.
As a payer, the payer entity needs to take a position on withholding tax, and that happens at the time of making of the payment. The
Yes.
payer may or may not know whether the payee is subject to equalization levy and would be paying the equalization levy.
Right.
Of course, ideal way is to get a written confirmation from the
Right.
payee that equalization levy would be paid, and then take a withholding tax position. That would be ideal. But
Yes.
without that, especially for online downloads, etc., where there is a risk on withholding tax, do you feel that the exemption section is appropriately worded for me as a payer to take a suo motu position that this is subject to equalization levy and not liable for withholding tax? Let's leave aside the debate on the assessment year applicability part for the
I agree. I get that point. See, I don't think that would be possible in my view, for the simple reason that the exemption section applies where supply is chargeable under the equalization levy, and me as a payer taking that position and the recipient not levying will become difficult. What we've been advising practically, is either go for a 195 or a 197 on this basis, to say that there is a declaration and he's paying a levy, and therefore give me a nil withholding certificate where amounts are large. I think we should think of something like that. Otherwise, in my view, the exemption is not worded so clearly for us to take a suo motu position not to withhold tax, assuming that it will be covered by equalization levy. I think a 197 or 195 too is a option worth pursuing, where you have a declaration from the recipient that he'll be discharging equalization. Just move on to the next one, which is again something that's set the cat amongst the pigeon on withholding tax. Again, this is the Pcom ruling. The SAC here, Pcom, which was Pakistan, India, Lanka joint committee, which was for organizing a World Cup in '96, which I'm sure all of us remember. The ICC was or is the organization which conducts cricket. So therefore, India, Pakistan, Sri Lanka was selected for hosting '96 World Cup. The host countries were required to pay varying amounts to the cricket board and associations of different countries, as well as ICC, for conducting these matches. Two bank accounts were opened by Pcom in London, operated jointly by representative of the boards, which received sponsorship, TV rights, etc., and deposited, and expenses were met from there. Surplus amount remaining in that bank was divided equally between the cricket boards of Pakistan and India, and paying a lump sum to Sri Lanka. From the bank account payments in India, certain amounts were transferred to the host countries for disbursement of fees payable to umpires, referees, etc. Pcom made payments from London bank accounts without deduction of tax at source. That's really the thing. And the payment fell into various categories, which is guarantee money to countries which did not participate, amounts dispersed to Pakistan and Sri Lanka, then payments to ICC, and there were few other payments of guarantee money. The tribunal, the tax authority actually held that these payments were taxable in India because they related to participation in matches in India, and the rest of the payments were not related to participation and they were not held, they were held not taxable. The tribunal upheld this ruling. The High Court also affirmed the view of the tribunal of holding that the first few payments are not through any source in India, but withholding tax under 194E was applicable, and the balance payments under 194E. And importantly, the High Court held that DTA is not relevant as it does not provide any exemption from payment of tax under 115 BBA. The provisions of 115 BBA are independent provisions, and once payment is covered under this section, the payment is subject to withholding under 194 E of the Act. Now, 115 BBA is tax on non-resident sportsmen and sports association, where sportsmen, who is not a citizen of India and is a non-resident, receives income from by way of participation of India in any game, advertisement, contribution of articles, etc. Income tax will be payable, and that's what 115 BBA says. And what 194E talks of. 194E talks of any payment to a non-resident sportsman, and 194E says where any income referred to in 115 BBA is payable to a non-resident sportsman who is not a citizen of India and non-resident or a non-resident sports association. The person responsible for making payment shall at the time of credit of such income of the account payment thereof deduct tax at 20% to be short. So 194E prescribes a rate for income covered under 115 BBA. The High Court suo motu held that the obligation to deduct tax under 194E is not affected by DTA, since that deduction is not final payment of tax, nor can be said to be an assessment of tax. Advantage of DTA can be pleaded and taken in the real assessee on whose account deduction is made by the payer. Irrespective of existence of DTA, the obligation under 194E has to be discharged when income under 115 BBA accrues. Now, the Supreme Court also said the payment is connected with the event scheduled to be played in India. The expression in relation to 115 BBA emphasizes the connection between game or sport played in India and the money paid. On application of DTA, again, the Supreme Court concurred with the High Court's view that the obligation to deduct tax under 194E is not affected by the DTA. Now, the real question here, which impacts and which is sort of bothering everybody, is what does this mean that the obligation to deduct tax is not affected by DTA, and the case the exigibility of tax is disputed, then on whose account it is made, the benefit can be DTA can be claimed at the time of assessment. Does this apply in all cases, and what happens? In our view, applicability of the decision for payments under 195 will not get impacted, because the DTA still overrides the rate prescribed under domestic law, because 195 requires a payer to deduct tax at rates in force, as against 194E, which says you deduct at 20%. Now, when you say 195 says tax deducted at rates in force, rates in force is defined, and that considers section 90 in DTA. Therefore, in our view, Pcom decision should arguably not apply to payments covered under 195. However, the payments covered under few other sections which are for non-residents, which are 194 LC, 196D, 194 LD, and few others, prescribe a flat rate of withholding without reference to rate in force. Then there is no enabling provision under which a deductor can access DTA for lower rate. Then the tax withholding as per the rate prescribed in the Act would need to be made without recourse to the DTA provisions. So here there's a clear distinction. I don't think because the Supreme Court has said that the tax reduction is not impacted by DTA and they can claim a refund, will not impact normal 195 payment. There we will still go by GE and other decisions to say that 195 will be based on what is income taxable in the hands of the recipient, and if there's no income, there is no tax liability, there would be no liability to withhold tax under 195. I think that would continue because of the use of rates in force and not a flat rate, unlike in 194E, LC, and LD. Again, on 201 and 201(1)(a), if there is no tax due in the income exempt under DTA and the person making the payment is not deducted, we should again be able to argue that there is no default, and then especially if the SSC has filed a return, even otherwise, if there is no default, there should not be a 201 consequence, and there should not be a consequence under 40A1 as well. So I don't think, in our view, we can take the ruling of Pcom in the comments in isolation to apply it for all 195 payments and all non-resident payments to say these would get covered, and therefore treaty will not apply and withholding will have to be done irrespective of the treaty rates. The second last issue that I would cover.
Ajay, just a minute here.
Yes.
Feel that there is some conflict between the Pcom and the Nagarjuna special bill decision, which was in the context of 206AA, where following the G technologies, that for the purpose of tax deduction, it is ultimately the chargeability of the non-resident in India needs to be considered.
Yes.
There is no point if the income is not chargeable to tax in India, then the non-resident should not be penalized by deduction higher tax and then file a return and claim the refund.
Yes.
Just because under 194B in Pcom case, the rate is specified in the section.
Yes.
Is it right just to ignore the treaty benefit and despite of non-chargeability of the income, deduct the tax at 10%, ask him to file the return and claim the refund?
See, logically and from a fairness perspective, I agree with you. Now, but for Pcom coming, but for it being a Supreme Court ruling, I would have completely agreed with you to say that it will not apply. The only thing is you can say that the Pcom ruling will also be applicable only in 194E in a particular context, the way 115 BBA is read and not otherwise. But the risk of, officer or the department viewing Pcom to apply in all cases where there's a fixed rate will always remain. Because if you see the Supreme Court or the High Court in that case, and the High Court ruling is a much more detailed one, does not talk of only the fact that DTA will not be applied. They say you can't apply it at the time of withholding, and if the recipient is eligible for the treaty rate, he can always file and get it back. And there is no, it is not a final tax. They say that it is only collection. It does create some issues, and I would think some clarification on how this Pcom thing will impact will be useful. But there are some people who are worried that this may actually impact even 195. In my view, that is too far-fetched, but in my view it may impact other sections where particular rates are there, because if you apply the same principles, it should apply in those other cases as well. The next issue is on secondment. Again, I'll just quickly run through this, which is a typical model of a employee secondment, and we are taking an example of US here. Let us assume employees from a US company are seconded on assignment to the India company. The services of the seconded employee are rendered to the India company under the control and supervision, with risks and rewards flowing to the India company. The salary of the seconded employee is paid by the US company, which is then reimbursed by the US, which is then reimbursed on cost to cost basis by the Indian company. The issue is really whether that reimbursement of cost recharged by would be constituted as a FTS or a FIS and chargeable to tax in India. The tax authorities are contending that that cross charge of expenses towards expat salary constitutes income, and the same should be subject to tax in India. Various judicial precedents, of course, have held that reimbursement of expenditure on a cost to cost basis would be constituted as FTS. There are a few things that we will have to keep in mind, that if the Indian company can substantiate that the Indian company exercises direction, supervision, control on the seconded employees and other matter related to them, even on lien of employment, termination, etc. The foreign entities per se not entering any services in India through the seconded employees. The functions performed by the seconded employees do not really make available any technical knowledge to the Indian company, of course, contingent on the treaty involved, whether make available language is there or not there. You can still be able to argue that it is not. Uh, in Bangalore, this is particularly prevalent, and I'm sure Pune would be no different given the amount of IT companies that are there. And we have had situations where the department has issued regular notices to all companies giving a list of all people who are seconded and the amounts being paid, etc. And they've been taking a view that any payment for seconded employees reimbursement, even if it is established to be cost to cost, is taxable in the hands of the foreign company and therefore liable to tax in India, and Indian company has a withholding tax obligation. There are also recent judicial precedents which have held that deputed employee would create a service fee in India and the foreign company would be responsible for the work of the deputed employee. I think here it will be good to draw a distinction between stewardship and deputation, which is activities in nature of stewardship do not constitute a service fee. If it is deputation, there could be a risk. But if it is stewardship, we could draw a clear distinction. What we are right now waiting for is a special bench has been constituted in Bangalore. The hearing was there last month, which didn't go on. It's got adjourned to December, and the special bench is in the case of IBM with regard to taxability of salary reimbursement made to various overseas companies. There are five questions which are framed. One is whether that payment constitutes income in the hands of the recipient, whether it constitutes FTS under the Act, FTS under the treaty, and whether the payments are liable to tax under 195. And if then can the Indian entity be treated as an SEC in default under 201, and whether they are liable to pay 201 money? This is really the issue before the special bench. uh, the special bench hearing is not been going on for a very strange reason. Firstly, it got adjourned because one of the two members of the three who were there had taken differing views on this and didn't want to go ahead. Currently, what has happened is one of the tribunal rulings is pending before the Karnataka High Court, and the revenue has raised an objection to say that if it is pending before the High Court, can a special bench adjudicate on a matter like this, and can a special bench be constituted? There are a few things which are open, but at least at this point, this is a issue which is existing. This is again dependent on documentation. I don't think we can take a view that in all secondment cases there would be a tax liability and we will have to withhold tax. I think factually, if we are able to establish that the employees are working under the direction control of the Indian company, there is no services being rendered by the foreign company. It's only the employees who are there. It is more of provision of those people and not the services, would not be liable. And I always take an example closer to what we do to see how we could think of this. If a client were to come to us to say, I want a return of income prepared, and enter into a services agreement for preparation of return, and two of the people from my team go every day to the client's office, sit there, work with them, finish the return. I think the service is still, the contract is still for provision of services of finishing a return of income. The contrary, if the client were to say, you please send me two people and I will take care of their salaries for the next 2 months and I'll get them to do whatever they have to do, and if they end up doing the return of income under their direction and supervision, it will still be a secondment because I've sent the people and they can do whatever. It's not a contract for services, it's actually a secondment of people, even though they may end up doing the same thing that I did in the first situation. Really, the distinction will be between what is a contract for rendering services as against sending people. I think if we are able to put that situation where the foreign entity is not actually rendering any services in India through those seconded employees, then there is a good cover both for secondment charges not being FTS or royalty and for service fee. I think that's a critical aspect rather than taking a position that all secondments will always lead to taxability. But this is going to be a vexed issue. This is something that tax office will examine. This is not settled yet. I don't know if the special bench coming out of Bangalore will settle the issue. There are rulings which are conflicting in any case, and this, unless there are some specific clarifications, etc., issue, this is going to be an issue for some time. The other question is on return filing. If a full credit for taxes is available in the whole country, a simple solution could be to treat it as FTS and claim a credit there. And then you will not need to file a return if tax liability is final and there's no further attribution of margin. And then if TDS is already done, there's no requirement to file return. We've at least been taking this practical approach where if the foreign company is able to get credit and in the whole effective tax rate doesn't increase and the group is able to get credit for this and there's no leakage, then why would you want to litigate in India? There will anyway be not a need to compliance and filing return, etc. Then the simple position could be for the Indian company to withhold taxes on these payments and the foreign company to claim credit at back home. The last point I had for discussion was the whole taxation of dividend and applicable treaty rate. This is really the question is on dividend distribution tax, which was existing until 1920 at 20 plus plus. So let's just say 20%. And then several treaties provide for lower rate of dividend taxation, whether it is Mauritius, Cyprus, Netherlands, Singapore, even US provides 15%. So it is all lesser than 20%. Then the key question is whether DDT can be restricted to the rate of tax prescribed under the relevant treaty. The real issue there is DDT a tax on the company or on the shareholder, and whether tax treaty will apply to DDT. There is a India-Hungary tax treaty where there is some clarification to say that it would be shareholder, can you apply the MFN clause? Is it possible to approach for low rate or get refunds? I think the indicative reference points are when the whole 115 was introduced. It's always come in, once it was brought in, there was an exemption given for dividends. The purpose and the intent behind introduction was administrative ease to collect dividends. So while it is a tax, while it is an additional income tax on the company, it was always intended to be a substitute of the shareholder tax. And the shareholders would end up receiving lesser dividend because of DDT payment, which effectively makes it a tax economically borne by them. There are a few judicial rulings which we could, there are a couple of Supreme Court rulings in slightly different contexts. One was Tata T on the constitutional validity of 115O, whether it is an income tax or not, and whether the government could bring in this levy. And there the Supreme Court has said that this will be an income tax, and again gone on to say that it will be an income tax and therefore it is valid. And the Godrej ruling was on 14E to say that would it apply, and there also they said that effectively it's a tax on the shareholder, and there would be tax that will be there on dividend income which has suffered tax. And there are a couple of Mumbai tribunal rulings which had remanded the issue back for examination when additional grounds were raised on whether DDT refund could be claimed. There is some international literature on this. One is a South African ruling where South Africa also has similar tax, and they had said that it is a tax on the shareholder. Now, what we have to see is it possible to contend that DDT rate must be restricted to what's in the treaty? Again, the whole thing is that it is because it is tax on dividend, therefore it has to be restricted. The India-Hungary tax treaty has that tax on distributed profit shall be deemed to be tax in the hands of the shareholder and it shall not exceed 10% of the gross amount of dividend. And protocol deems what we'll have to see and whether the Indian company shareholder liability or does it deem tax on distributed tax to be a profit in the hands of the shareholder. Now, here, I think we'll just jump to the latest decision where the Delhi tribunal actually held that the DDT rate would be restricted by the India-German DTA. And the tribunal actually held that the reduced rate on dividend income under the DTA prevails over the DDT rate under the income tax. And they said DDT is a tax on dividend income. They've examined and it's on the very speaking orders on this issue. They have looked at section 4590 to say it's actually a tax on the dividend income. The levy of tax on any income beneficially derived by the German resident is subject to India-Germany tax treaty. And then they say retrospective amendment cannot be applied to tax treaties, and they see when the German treaty was signed and therefore it applies. And they have restored the matter back to the AO only for verifying beneficial ownership and existence of PE. Otherwise, the Delhi tribunal has held that the India-German DTA rate will be applicable even in case of DTA, in case of dividend distribution tax. this does change quite a few things on the past issues, especially if the refund can be made. And even in this case, this was raised as an additional ground. This was not something that was examined in the assessment. I think this is a good case for companies to now go back and see where in the past years DDT has been paid, and if the treaty rates are lower, worthwhile pursuing some of those claims. Sachin, Amey, that's all I had from my side. If there are any questions, etc., we could take some of those.
Ajay, regarding this last point, this GSEC decision,
Yeah,
where they have accepted that the treaty low rate is to be applied, and after holding that, they have restored the matter to the AO.
right.
On the administrative fund, if at all the refund is to be granted, how it can be claimed and to whom it is will be refunded? Whether NRI shareholders will get it or the deductor.
I think it only the Indian company can get it. The Indian company has paid that DDT and has paid the taxes, additional income tax, and the charge, so to say, will be on the Indian company. I don't think the foreign company can get the so to say the refund. And even the claims in this case have been made by the Indian companies itself.
Okay.
Ajay, Amey here. Quick question: the claim for DDT refund made by the Indian companies. Could you just share your practical experience as to how one has gone about the process? Is it like a letter with the jurisdictional commissioner or the assessing officer? That has been a starting point. Any other practical experiences would be useful.
Good question, Amit. There have been slightly different approaches depending on where the issue is. So, in cases where we are on a assessment, there is a 143.2 issued and scrutiny assessment is in process. We have filed a letter with the assessing officer, additional claim in the assessment, and we hope that if he does not grant it, and I don't expect any assessing officer to grant it at the AO stage, but take it up on appeal. Where there are appeals pending in tribunal, CIT appeals, etc., we've raised it as an additional ground in those, which is what had happened in this Delhi High Court, Delhi Tribunal also. Alternatively, where there is no
Kishore, hello, Kishore, your line is needs to be muted, please. Thank you. Sorry, Ajay, go ahead.
Yeah, I mean, in a case where there is no assessment open, the assessment is not ongoing, there are no litigation appeals pending, etc., we've actually gone about making an application or a claim under 237. 237 is refunds, and 237 says that if any person satisfies the assessing officer that amount of tax paid by him or on his behalf or treated as paid by him exceeds the amount which is properly chargeable under the act, he shall be entitled to a refund of the excess. So we've gone ahead making claims under 237 where there is no specific appeal, etc., open. Years where appeal is open, it's additional ground. Years where there is assessment is ongoing, we made a claim. Otherwise, even on years where assessment is concluded, we have filed 237 claims.
Okay, thank you, Ajay. Very useful. Thank you.
Ajay, at the time of where the assessment is going and 143.2 notice is issued, but if the assessing officer is not required to pass the separate order as such for DTT, then?
So actually DDT, there is no separate order in any case. And, unfortunately what happens is, let us assume that you have paid this DDT for 1920 or, where a return is to be filed, or if you want to revise your return. The return form also does not permit you to claim a DTA amount and claim a refund in the return of income. So you can't do that. Now, even in the past where there have been short payment of DDT, etc., it forms a part of the 143.3 only. There's no separate proceeding, separate thing that they do. Therefore, a claim for DDT also gets addressed in the 143.3. We've seen that. But, practically at a assessing officer level, it is likely to be rejected, and we take it as a ground in the appeals.
Any other questions from the audience?
I mean, there is one question on whether it can be made under 264, where there are no appeals, etc., pending. And I think, that is just, I don't know if we can try a 264. Nothing bars us from trying a 264 because you are revising, and if an assessment is already been done and appeal is not pending, I think we could do a 264 and also file a 237 application. I think 237 is a stronger one because we are telling that I have paid in excess than what I have to pay and you have to grant me a refund.
Right. Any other questions from the audience? Okay. So I think we are sort of coming to the end of this very, very interesting session. I request Rajendra to present a vote of thanks on behalf of the Pune chapter of Chamber. Rajendra?
Yeah. Am I audible?
Yes.
Dear friends, Ajay has really dealt with the top international tax issues. His presentation was very lucid and full of clarity of the thoughts and update with the latest case laws, including the controversy on the Pcom. I think the practitioners in the international tax area have to dealt with all these issues very frequently. That is withholding tax scenario, MLI, treaty benefit, recent one, the equalization levy, etc. Though I think the title of the topic or the study circle title that it's covering only the 10 top tax internal issues, I think the topic itself, the title itself was a misleading. I think the Ajay through his presentation has put up before us the entire clause-legal commentary and touched the every area of the international tax practice. The Ajay, thank you very much on my personal behalf as well as on behalf of the CTC Pune Study Circle Group. And really the presentation was very excellent. I am sure that all the participants have benefited a lot. And I thank to all the participants that on Saturday morning they joined for this very detailed session on the international tax issues. Thank you very much.
Thank you, Rajendra, and thanks, Amay and Sachin, for this opportunity. I really enjoyed preparing for this presentation. Thank you so much.